50 minutes left of trade. Lemonade stock has been on an absolute tear since its market debut back in July. But shares turning sour today after the company provided weaker than expected guidance. Lemonade CEO Daniel Schreiber joins us now for an exclusive interview. Welcome back to the show, Dan. And the context for your stock is important. You priced at 29 back in July. So it's been a moonshot. Is it just high expectations, or is growth slowing as far as the outlook disappointment?
Yeah, growth has been pretty spectacular. So we just wrapped and announced our 2020 results. We're talking about 87% growth year on year, and we're projecting something similar for this coming year. So we're going to continue to grow pretty aggressively. And to put that in perspective, we've been in market for about 5 years. After our not even 5 years, I should say, after 4 years or so, we hit 1 million customers. It took some of the other spectacular companies in the US in this space, like USAA, 47 years to get to that metric. So you're talking about something like 5 to 10 times faster growth than incumbents have experienced in the past, a real order of magnitude increase. And it's not only the top line. We're seeing increases in all of our key performance indicators, including our marketing efficiency. So we doubled our business even as we halved our costs of acquiring new customers. So everything's going pretty much in a positive direction.
What about Texas in particular? You did talk a little bit about how I think 1/4 of your customers are in the state of Texas. So how are you impacted by the weather situation, and how long is that set to last as a financial potential hit for you?
So the results we announced today were for 2020, and the Texas freeze really hit in February of 2021. So we haven't announced too much, but I will tell you that it's a big deal, not only for people in Texas, but for our company, because as you say, about 1/4 of our customers are in Texas. So for us, it was really a test both of our people and our technology, as well as our financial model. What we found is that we saw a huge influx, a real surge of claims, thousands of claims in a very short period of time. And I'm very pleased to say, and indeed very proud of the team, who were able to handle that surge and deliver stunning quality of service to our customers. Thousands of claims, but most of them are already closed, and the others are closing pretty quickly. So this is a time for us to test ourselves. We promise amazing service, and I'm really pleased that the team was able to live up to it. And it's also a test of our financial models. You know, we have a pretty unorthodox structure of reinsurance, and it is performing the purpose that we assigned to it. So even though we are going to see a spike in our loss ratio in the first quarter because of this major catastrophe, our guidance for the quarter and for the year don't reflect any major dampening despite that. So we really are seeing that both our people and our financial models are delivering as we'd hoped.
You've teased, Daniel, a pending product launch. Are you able to share with us what that is, which sector?
So we've changed a lot in terms of our product. You're quite right. When we IPO'd just a few months ago, we were a monoline business. We only sold homeowners, renters, condo, but homeowners insurance. And in the short intervening months, we've launched pet insurance, which is doing spectacularly well, and life insurance. We're crossing invisible boundaries in the insurance space to go from health to life to property and casualty. And you're absolutely right, we're not done, and we did hint that we've got a major launch coming. In fact, we have more people working on this yet to be announced product than on any of those other products that I just mentioned. So it's a source of great excitement internally, but I'm sorry, Wilford, to disappoint you. I'm not going to pre-announce it right now.
Keep smiling if it's auto insurance.
Does that count?
There we go. I think we've got it. Sarah.
I think you got your answer.
It's involuntary, so don't catch me on that.
Just in terms of your model, I mean, you're obviously growing very fast. It's asset light, it's digital, it's AI focused. Is that what is making it so hard for the traditional insurers to compete with you?
So I don't envy the traditional incumbents really going into the 21st century when the world has changed so dramatically, and they were engineered for a different era. Insurance incumbents in the US are huge. They're also not so young. The average age is about 125 years old, so they were built during the era of the horse-drawn carriage, and of course the world has changed so much, and you just wouldn't build a company in the 21st century the way you build them in the 19th century. So a great deal has changed, and I think that what they're discovering is that so many things that they thought were assets, as the world transforms, are actually revealing themselves to really be liabilities. So for example, insurance companies, incumbents are very proud of their 40,000 broker distribution network. Is that in the age of the direct-to-consumer app-based distribution, is that an asset, or is that really an albatross around their neck? And they're very proud of the technology stack that they've been building since the 1980s, but we don't program in COBOL anymore, and it's really become, instead of a black box that does amazing algorithms, it's a black hole into which they just pour billions of dollars in order to stand still and contend with all the spaghetti code. And they've got amazing people that they've cultivated for generations for legacy preservation, but what they really need is a team that is adept at business transformation. So culture, technology, and even their investor base. They've got an investor base who want, the 5% dividend dependably without any risk or volatility. So none of those things, none of those structural aspects of their business prepare them for what's coming. So I think our advantage is structural, it's secular, it's to do with the transformation that the world has gone through, and it's just better to be founded in the 21st century if you want to build something for the 21st century.
So Daniel, that and some of the other factors we've discussed in this interview and the last interview explain why you think you can take market share from existing players. What about looking out over the next 5 to 10 years more broadly, whether there's the opportunity to provide insurance to the uninsured or people that have never really considered insurance before, again, because perhaps they've either not afforded it, not considered it, or just never been in a place to transact in that way, and the sort of smartphone might enable that in a way that they've not had the opportunity to take up in the past.
Absolutely, and I'm proud to say that I think that's happening already now and has for the last couple of years, so this isn't only kind of a forward-looking statement. We found that we have sold renter's insurance, which is oftentimes the entry-level insurance product to consumers, in ways and for ages and at price points that have been hitherto unknown. People just haven't seen that before. So we've really been able to reinvent that category from a high intent kind of acquisition to pretty much an impulse buy. Loads of people who buy lemonade hear about it from their friends, they see it on social media, they give it a try, they find out that they can buy insurance in 90 seconds, and for $5, it's, costs half or less than half oftentimes than incumbents. And it doesn't involve all the bureaucracy and the paperwork that they had come to expect. So we are seeing that we're mainly selling insurance. In fact, something like 90% of our customers are people who hadn't bought insurance before. So there's no question that we are enlarging the pie and dealing and offering products to consumers who hadn't bought insurance before. And I'd like to think that that kind of ease of use, simplicity, dependability, aligned values, and the social impact and charitable dimensions to our business, all of that wrapped in an app that gives you insurance in 90 seconds, pays your claims in as little as 3 seconds, does profoundly enlarge the pool of people who can avail themselves of this important product and social good.
Daniel, thanks so much for joining us. Good to see you again.
Great to be with you.
Off the break, failing the test.